Imagine waking up tomorrow to a financial revolution so profound it renders the global currency markets you know today completely obsolete. A world where the dollar and the euro have been dethroned not by another Western power, but by the two most speculated currencies on the planet, the Iraqi Dinar and the Vietnamese Dong. This is the powerful, intoxicating dream that fuels countless online forums and YouTube channels, a vision of overnight millionaires created from a simple suitcase of banknotes bought for pennies. But I am here to pull back the curtain on this fantasy and reveal a truth that is far more compelling, complex, and grounded in the brutal realities of global economics. The real story of the dinar and the dong is not one of a magical revaluation switch about to be flipped, but of two nations on a collision course with destiny, navigating a treacherous path toward economic sovereignty in a world that is rapidly fracturing into a new financial order. The connection between Baghdad and Hanoi is not one of a secret pact, but a parallel journey, one emerging from the ashes of war and sanctions, the other from the disciplined furnace of communist capitalist transformation, and their collective movement is what is truly setting a global wave in motion. To understand this wave, you must first forget the hype and look at the cold, hard data. Iraq, sitting on a verified 145 billion barrels of crude oil, possesses one of the largest energy reserves on Earth. A treasure trove that should, by every conventional economic model, translate into a powerhouse currency. Yet, as of 2025, it requires over 1,300 Iraqi dinar to purchase a single US dollar. This staggering disconnect is the central paradox that speculators latch onto, but they often ignore the why. The answer lies in a perfect storm of political fragility, a government budget that is over 90% dependent on oil revenues, and a banking system so porous that it has allowed billions of dollars to be illicitly funneled to neighboring Iran and Syria through sophisticated trade-based money laundering schemes. This isn't a conspiracy. It's a documented fact that led the U.S. Treasury and major international banks like J.P. Morgan to severely restrict dollar transactions with Iraq in 2023, creating a liquidity crisis that sent the black market value of the dinar plummeting. So, the latest updates for 2025 are not about a pending revaluation announcement, but about the Iraqi government's desperate multi-front war to reclaim control. The Central Bank of Iraq is aggressively pursuing a digital dinar, a central bank digital currency, CBDC, designed not for speculators, but as a surgical tool to bypass the corrupt banking corridors, create a transparent transaction trail, and finally plug the leaks that are draining the nation's dollar reserves. Simultaneously, the government is pushing a painful but necessary policy of forced de-dollarization, mandating that internal trade and salaries be paid in dinar to build domestic demand for their own currency. This is the unglamorous, gritty work of nation building, a far cry from the sensationalist rumors of secret meetings in Geneva. Meanwhile, halfway across the world, Vietnam's story offers a stunning contrast. While also subject to speculative fever, the Vietnamese Dong is backed by a tangible, roaring economic engine. With a GDP growth rate consistently punching above 7%, Vietnam has cemented its role as the indispensable China Plus One manufacturing hub for the world's tech giants. Companies like Samsung, Apple, and Intel have poured hundreds of billions of dollars into the country, creating a massive sustained influx of foreign currency that naturally exerts upward pressure on the dong. But here's the critical twist that speculators often miss. The State Bank of Vietnam, SBV, does not want a strong dong. Its primary mandate is stability and export competitiveness. A rapidly appreciating currency would make its factories more expensive and kill the golden goose of foreign direct investment. Therefore, the SBV actively manages the dong's value within a tight band, aggressively buying up the incoming dollars and stockpiling them into its soaring foreign exchange reserves, which now stand as a formidable buffer against global economic shocks. The true global wave is this collective movement away from a dollar-centric world, not through a sudden collapse, but through the deliberate, strategic actions of emerging economies building their own financial fortresses. The narrative surrounding the Iraqi dinar in 2025 is a tale of two economies existing in parallel. The one measured by the official exchange rate, propped up by the Central Bank of Iraq's dwindling reserves and political will, and the one lived by everyday Iraqis on the street, where the black market rate tells a much more honest and brutal story of a currency struggling to find its footing. To cut through the noise, we must move beyond the simplistic mantra of oil equals value and delve into the intricate web of legislation, geopolitics, and infrastructure that truly dictates the dinar's potential. The cornerstone of any legitimate hope for a stronger dinar is the ambitious and perpetually delayed national oil law. This isn't just another piece of legislation, it's the key that could unlock trillions of dollars in foreign investment. The current legal framework is a patchwork of regional and federal disputes, particularly between Baghdad and the Kurdistan regional government, which has led to catastrophic shutdowns of pipelines and international arbitration cases that have scared away the very super major oil companies Iraq desperately needs. These companies don't just extract oil, they bring cutting-edge technology, massive foreign capital, and a demand for financial transparency that is poison to the corrupt networks that currently thrive. The passage of a unified oil law, which would clearly delineate profit sharing and contractual terms, would signal to the world that Iraq is finally open for business in a serious, structured way. And that signal would be the single most bullish indicator for the dinar in decades. But oil is only one part of the equation. The other is the Herculean effort to rebuild a nation not with bricks alone, but with trade routes. This is where the real latest updates for 2025 become tangible. The Grandfa Port mega project on the Persian Gulf is not a mere construction site. It is Iraq's audacious bid to become a global logistics hub, a rival to Jebel Ali in the UAE. When completed, it will be one of the largest ports in the world, capable of handling the biggest container ships and, crucially, connecting directly to the Dry Canal, a network of high-speed rail and road lines that will stretch across the country to the Turkish border, creating a new Silk Road that bypasses Iran and gives Iraq unprecedented leverage. This is about economic sovereignty. Every container that moves from Asia through Grandfa and across Iraq to Europe represents fees, jobs, and most importantly, a reason for the global financial system to hold dinar, not just to sell it for dollars. This physical infrastructure is being complemented by a financial one, with the CBI slowly building relationships with central banks beyond the Federal Reserve, including those in China and the EU, to establish direct currency swap lines that would reduce their dependency on the dollar for international trade. Yet, for all this monumental progress, the specter of political instability remains the single greatest anchor on the dinar's value. The government formation process is still fraught with sectarian gridlock, and the influence of Iran-backed militias creates an environment where international investors, despite seeing the potential, remain on the sidelines, fearing that their assets could be nationalized or their operations disrupted by sudden violence. This political risk premium is baked into the dinar's weak valuation. Therefore, the path to a revaluation is not a straight line. It is a painful, iterative process where every step forward in infrastructure is tested against 2 steps back in political squabbling. The speculators waiting for a single dramatic event are missing the entire picture. The true turning point will not be announced on the news. It will be a slow, cumulative process visible in monthly trade data, in the steady increase of non-oil GDP, and in the gradual narrowing of the gap between the official and black market exchange rates. It will be the day when an Iraqi company can reliably import machinery from Germany by paying in dinar from a letter of credit backed by a Chinese bank, completely circumventing the dollar. That is the finish line, and while the journey has arguably begun with these massive projects, the road ahead remains long, arduous, and filled with obstacles that no amount of online speculation can wish away. Now let's pivot to Southeast Asia, where the story of the Vietnamese Dong unfolds with a discipline and strategic clarity that stands in stark contrast to Iraq's turbulent journey, yet it is precisely this contrast that completes our understanding of the global financial realignment. Vietnam is not battling for economic survival. It is orchestrating a masterful, long-term campaign for regional supremacy and sustainable wealth. The Dong's trajectory is not a speculative gamble on a post-conflict recovery, but a calculated investment in the most successful emerging market story of the 21st century. The numbers are undeniable. Year after year, Vietnam's GDP growth outperforms global averages. Its exports have swelled to over $350 billion annually, and its trade surplus is the envy of the developing world, creating a constant and powerful inflow of dollars, euros, and yen. This massive trade surplus is the fundamental bedrock upon which any rational argument for a stronger Dong is built. However, the State Bank of Vietnam, in a display of expert economic stewardship, actively suppresses rapid appreciation. They do this by consistently buying up the foreign currency, flooding into the country, and amassing it into monumental foreign exchange reserves, which now comfortably cover months of imports. This strategy is not about depriving speculators. It is about maintaining the country's blistering export competitiveness. A stronger dong would make the smartphones, sneakers, and furniture rolling out of its factories more expensive on the global market. And Vietnam's entire economic model is built upon being the reliable, cost-effective alternative to China. This is the critical nuance that the revaluation community often overlooks. The Vietnamese government's goal is stability and controlled, gradual strengthening, not a volatile spike that could jeopardize its hard-won position in the global supply chain. The real updates for 2025 in Vietnam are found in its relentless upgrade into high-value manufacturing. We are moving beyond textiles and basic electronics into the realm of semiconductors, electric vehicle batteries, and advanced components. Companies like Samsung are not just opening new factories. They are establishing their largest global research and development centers in Hanoi, signaling a deep, long-term commitment that transcends cheap labor. This shift to a knowledge-based economy demands a different kind of financial infrastructure, and that is where the next phase of the Dong story will be written. The government is aggressively reforming its stock and bond markets, loosening restrictions on foreign ownership, and pushing for upgrades from frontier to emerging market status by major index providers like MSCI. Such a reclassification would trigger a tsunami of passive investment from global pension and index funds, all of which would need to purchase dong to buy Vietnamese assets, creating a structural, sustained demand for the currency that has nothing to do with speculation and everything to do with institutional confidence. So, when we step back and connect the dots between the Iraqi Dinar and the Vietnamese Dong, the true global wave in motion comes into breathtaking focus. It is the story of de-dollarization not as a political slogan, but as a practical, operational reality for nations seeking to carve out their own spheres of economic influence. Iraq is attempting to escape the dollar system from a position of vulnerability, using its oil as a lifeline. Vietnam is engaging with the dollar system from a position of growing strength, using its manufacturing might as a lever. Both are actively building bilateral trade agreements that bypass the dollar, whether it's Iraq negotiating with Jordan or Vietnam with Japan, to settle trade in their own national currencies. This is the quiet revolution happening in the back offices of central banks and finance ministries. A revolution far more significant than any online rumor. For you, the investor and observer, this means the fantasy of a life-changing overnight revaluation is a dangerous distraction. The real opportunity lies in understanding and tracking these profound macroeconomic shifts. The value will accrue not to those holding physical banknotes in a safe, but to those who have the patience and insight to invest in the economic transformation of these nations through their stock markets, in infrastructure projects, or in the businesses that will thrive in this new multipolar world. The journey of these two currencies is a powerful lesson in geopolitics and economics, teaching us that true wealth is built not on secrets, but on understanding the undeniable tides of global change. Now, I want you to take this knowledge and act on it. The first step is to solidify your understanding, so I have a crucial task for you. Go down to the comments section right now and tell me one thing. Which of these two currencies, the Iraqi Dinar or the Vietnamese Dong, do you believe has the more realistic path to sustainable strength in the next 5 years? And based on what specific factor we discussed today? Let's get a real debate going. And if this deep dive into the real forces shaping our financial future has provided you with more clarity than 100 speculative videos, then you need to become a permanent part of this community. Hit that subscribe button and ring the notification bell because our next analysis is already underway, where we will break down the specific companies and sectors in Vietnam that are poised to dominate the Asian market, and you will not want to miss it. The global wave is here. Make sure you have the knowledge to navigate it.